Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good morning, Haydn.
Good morning.
Okay, so let's kick off. The US Federal Reserve and the Bank of England recently announced that they are keeping interest rates the same. With inflation continuing to fall, what is the likelihood of interest rate cuts happening later on in the summer?
Well, there's a good chance of interest rate cuts in the summer. I suppose it does depend on what you actually mean by the summer, but certainly perhaps by the end of August. So let me just start by saying that. So interest rates are coming. The Federal Reserve has been saying for some time it expects to cut interest rates 3 times this year, and that advice hasn't changed. But I suppose to put things in context, at the start of this year, the markets were thinking that actually the first interest rate cut could come in April, maybe May, and central banks in the US, in Europe, and the UK would actually be able to cut interest rates 6 times this year. Was they're expecting 3 cuts this year. So certainly, well, it looked certainly in January that perhaps markets were being a little bit too optimistic about the scope for central banks to cut interest rates, and they've had to row back on that. And now expectations of 3 cuts this year seems a lot more reasonable. Perhaps there's a little bit of doubt about the US Federal Reserve in particular, but certainly the UK and the European Central Bank look pretty much on course to cut interest rates with reasonable certainty in the summer. So in the case of the UK, for example, we'd be expecting a cut in August or September. In the US, certainly the markets are expecting a cut in either July or September. But certainly it looks as if we'll see some cuts, certainly by the autumn at least, perhaps if not by the summer. And I suppose you can't really talk about the interest rate outlook without talking about inflation. So you're right to point out that inflation has come down quite markedly since its peak. In the case of the US, UK, and the Eurozone, inflation this year is expected to be the lowest. This is over the course of the year. Is expected to be the lowest we've seen since 2020. So very good news on inflation there. In the case of the UK, we may actually see headline inflation dip below the Bank of England's 2% target by the end of the second quarter. And that's one of the reasons why I can say that it's more likely the Bank of England will be able to cut interest rates by the summer than perhaps the Federal Reserve. In the case of the US, inflation's been a lot better behaved than it has been in the UK. It certainly came down earlier and it stayed lower for a longer period. But the issue is that the US economy has been doing so well, it's been growing so strongly that the Federal Reserve is finding it very hard to get inflation from 3% to its 2% target. And that is essentially what is staying its hand. And that's why it is sort of postponing cutting interest rates, even though it's made a lot of progress on inflation. And the ECB is sort of in a similar position to the Bank of England. So the UK has experienced very weak growth over the last 18 months. So has the Eurozone. Inflation has come down. It's much closer to its 2% target, and certainly will be in the next 3 or so months. And so as a result, it feels like it's got perhaps won most of the battle. It doesn't want to admit that, but it's perhaps got a little bit more scope, given that background, to cut interest rates than the Federal Reserve. And that's one reason why the markets are thinking that perhaps the ECB might be the first central bank to cut rates in July, possibly in June or possibly July, whereas the Federal Reserve might be leaving it to the autumn or perhaps even later. I suppose just to finish, why is it in the case of the US is inflation proving so stubborn to stamp out, given that US inflation peaked over 18 months ago, and it's really all about growth. So as I said, the UK and the Eurozone have barely grown over the last 18 months. Growth is now starting to pick up by the looks of it in both those regions, and that's good news. But in the case of the US, it's just been that the US basically defies all predictions of any slowdown. So at the start of this year, US growth was expected to be just about 1.2% over the course of the year. So that would be below its trend rate of growth. And if you're trying to get inflation under control or bring inflation down, generally you want the economy to be growing less quickly than the economy would grow in the long run and below its potential rate. But now economists are expecting the US economy to grow at about 2.5% this year. And that is at or perhaps even slightly above the US trend rate of growth. So that is essentially why it's getting difficult for the Federal Reserve to bring down inflation that last 1% to its 2% target, and why the markets have really pushed back on their hopes of 6 rate cuts this year, and even the prospect of 3 rate cuts could be confounded if the US economy continues to go at these breakneck speeds. That said, there are signs that wage inflation in all of the major regions is tempering. Wage inflation has actually been quite well behaved in the US, given despite the strength of the labour market there. It's now back below 3%. In the case of the UK, that's where wage inflation really has been a problem. We've now seen wage inflation really dip below 6% for the first time since the end of 2022. So the reasons to believe that inflation will be able to come down and allow even the Federal Reserve, despite that strong background of US economic growth, will allow central banks to be cutting interest rates by the summer, or the late summer or early autumn at the latest.
Thanks, Haydn. So this year we will also see elections in the UK and the US. With Labour significantly ahead in the polls and the US election looking to be tightly contested, what could the potential impacts be for markets?
Certainly, the second half of the year and the US election in particular is going to raise a lot of risk in markets and increases uncertainty. So the markets are already, and the markets don't just trade government bonds and commodities and equities, they also trade uncertainty, they trade risk. And certainly the markets that trade the instruments that are related to risk, they are showing significant increase in a premium for taking on risk during the US election, because it is going to be a very tight call, and there's certainly the outcomes or potential outcomes are perhaps more bipolar than is the case of the UK. So let me just talk a little bit about the UK first before I come back to the US. So by and large, the markets don't really care who wins the UK election. That sounds an awful thing to say, but the reason for that is that from an economic policy perspective, whoever wins the election is probably going to pursue very similar policies. One reason for that is that Labour has pretty much pledged not to raise taxes. It's promised to manage the economy in much the same way as the Conservative Party. The Conservative Party, in turn, have adopted some Labour policies in advance. So, for example, the recent change in the treatment of the taxation of non-domiciles. So there isn't that much to choose between the parties from economic perspective. And both parties, or whoever wins the election, inherit an awful fiscal outlook. So we have both taxes and public spending at the highest levels that we've seen since the 1970s. So whoever wins the next election will find it difficult to balance the books. They'll find it difficult to raise taxes. And we also have the public debt, the national debt at just under 100% of GDP, and its highest level since the aftermath of the Second World War. So there's very little scope for whoever wins the election either to raise taxes or really change the sort of the fiscal dynamics in any particular way. Now, potentially, so the markets would be worried if an incoming government, and it's more likely to be Labour than Conservative on this score, the markets would be worried if that government decided to increase borrowing noticeably, perhaps to pay for greening the economy, green policies, as Labour had promised to do. But they've rode back on that because the debt is now so high that the likely interest costs of that kind of extra deficit spending would be prohibitive. So from an economic perspective, there is almost nothing to choose between the parties. So I don't think the markets are really paying much attention to a UK election. If Labour were to win, it's more likely they can be perhaps a little bit more daring, perhaps in their second term. In the first term, they really are focusing on trying to establish their credibility. So there really won't be that much difference between a Labour government and a Conservative government from an economic policy perspective. So the markets, by and large, really aren't paying much attention, as I said, to whatever is happening in the UK. Now, the US is another matter entirely, and that is because there are a range of outcomes and they all mean different things. And the difference between Biden and Trump is so stark that it really is very difficult to sort of plan for what could happen afterwards. I suppose the one important thing to remember with this election is it's not just the US president who's up for election, it's a lot of senators and it's a lot of congressmen and congresswomen in the House of Representatives. And the consequences of whoever wins the presidency, it's not just the president. If they don't have control of both the House of Representatives and the Senate, they pretty much can't change very much. There are some exceptions there, as I mention in a minute. But for example, let's say Trump were to win the presidency, and the polls are probably overstating that risk. If he were to win the presidency and not win, the Republicans don't win the Senate and the Congress as well, he can't really do much on taxation. In fact, the tax cuts he introduced in 2017 will expire in 2025 unless they are renewed by both the House of Representatives and the Senate next year, which looks unlikely because it looks unlikely that the Republicans will win both houses. And so from that perspective, a Trump presidency is not the sort of tax cutting presidency that perhaps we saw in his first term. And I suppose that's important to remember, that a second Trump presidency may not resemble the first Trump presidency as much as you might think. In terms of, I mean, at the moment, it does look as if the Democrats will either win over the Senate or retain control of the House of Representatives. So at the moment, it looks as if whoever is president, they're going to have a divided House, which is going to make it difficult to get much done. I mean, we've seen that in Biden's first term, that it's been very difficult in the last couple of years once he lost control of both houses. Now, there are two, I suppose, areas where Trump, or maybe three, where the markets will worry. The first is nothing to do with policy. It's just that Trump is Trump, and he's very unpredictable. And what he says is not always what he does. So there will be some concerns over that, and no doubt the markets will be wanting to see some more clarification on that if Trump were to win the presidency. So there will be uncertainty and nervousness leading up to between Trump winning the election, which, as I said, is not by no means a certainty and not as likely as the polls are saying, and him eventually taking control of the White House. Now, the two other areas of concern are foreign policy, because the president has an awful lot of discretion on foreign policy, and that includes tariffs and trade, and then also on immigration. So Trump coming in, we know that he's anti-immigration. He has an awful lot of power. He would have an awful lot of power to increase deportations and reinforce border spending. Immigration would be lower, and possibly it would start to come down quite quickly. And that would have consequences for US economic growth, because these are immigrants who are contributing to the US economy by working, maybe working without the right legal protections, but they are contributing to the US economy. So that would impact US growth, and it would impact US firms. At the same time, of course, that would be a concern for Mexico because an awful lot of those workers, they work in the US and remit money back to their families in Mexico. So there'd be a ripple-on effect here, and so that's negative for growth. But the big concern would be on trade. So Trump has said in his own words, "I am a tariff man," and he has indicated, and yes, again, Trump doesn't always do everything he says he's going to do, but he's indicated that he's going to raise tariffs on imports from the rest of the world by, in the case of China, maybe 60%, and in the case of, say, Europe and the UK, 10%. And that would be very disruptive. But last time we saw Trump increase trade tariffs, which was back in 2019, that certainly derailed markets for the best part of a year. So that's a big concern, and it'd be a big concern particularly for Europe because, for example, if China is finding it prohibitively expensive because of these tariffs to sell electric cars into the US, it's going to have more electric cars that it potentially can sell into Europe and the UK. It has such a surplus of electric cars at the moment. Basically, it really wants to be able to sell them wherever it can. So that would be one concern for Europe, the fact that essentially products that China was planning on exporting to the US are instead sort of diverted to Europe and the UK. At the same time, of course, 10% increase in tariffs so that European exports are more expensive to the US would be very detrimental to the European economy, which is very export dependent, particularly Germany. And that potentially could derail the recovery that we're seeing in the Eurozone and the UK at the moment. So Trump there is potentially a potential risk, but as I said, the polls certainly overstate his chances of winning. And of course, of all the states in the US, there are only 5 or 6 that actually determine the outcome of this election. So essentially, all the other states, it's the outcome has already been decided. So it's a very small number of voters actually out of the U.S. population who will be determining this outcome, and I suppose that's why this is such an event and of importance to the markets because it really does depend on a relatively few number of people. So in the second half of the year, we're certainly going to see more uncertainty because of the US election and what a Trump outcome means compared to a Biden outcome. But again, just to reiterate that if the House is divided, then certainly apart from on trade and foreign policy, the president has very little he'll be able to get done.
Thanks, Hayden. So on the back of that, we've seen markets perform well over the first quarter of the year. Given what we've just covered, is it likely to continue or are there additional challenges ahead?
Well, certainly the second half of the year, last quarter, is going to be a period of uncertainty. So that's probably a bit when markets are certainly going to take a step back, notwithstanding that the last quarter of the year is usually a pretty good time for equity markets. But certainly that is, I suppose, when we can predict that there's a good chance of markets taking a breather. I think you're right to point out that equity markets in particular have had a good quarter because bond markets haven't. So global equity markets in sterling terms have risen about 8 to 9% so far this year, and about double that since the end of October. So they've had a good run. Europe is up 10% this year, and Japan the same, although actually 17% or so in local currency terms, as the Japanese yen has depreciated noticeably. So they've both risen about 10% in sterling terms this year. The exception, unfortunately, is the perpetual laggard. It would seem the UK. So the FTSE 100 is up about 2 or 3%, and the FTSE 250, which is obviously much more exposed to the local economy rather than the global economy, it's barely up at all. So the UK's been lagging, but other markets have done very, very well. Now, there is an adage in stock markets, and that is that bull markets, i.e. rising markets, bull markets don't die of old age, and the same could be said of bear markets, falling equity markets. So it's tempting to think that just because markets have done well over the last 6 months or last 3 months, that, well, that's it. and the best times are behind them, and there's not much prospect of further gains. And whilst that's tempting, of course, what matters is the strength of corporate earnings growth, the strength of the economic backdrop, what's happening with interest rates. So really, for markets to step back noticeably here, well, we would need to see really weakening US economic growth, and with that, weakening US profits. And at the moment, investment analysts expect almost double-digit earnings growth, profit growth in the US. So that doesn't look very likely at the moment. Or we would need to see inflation spark up again, so that central banks, rather than looking as if they're going to be cutting rates this year, will have to raise interest rates. So we would need to see some bad news to derail the current bull market, the current buoyant equity market. But obviously, if there's that bad news, then that essentially would trigger a little setback in equity markets. Now, of course, bond markets, yeah, they haven't had such a good year. So I think gilts, UK government bonds, have fallen about 2% this year. UK credit has done a little bit better, but bonds, either they've broken even global from a global perspective, or they're a little bit down, and that is because, as I sort of said earlier in this podcast, that at the start of the year, markets were expecting central banks to be cutting six times this year, and now they're expecting only 3 cuts. But at the same time, once central banks do start to cut, markets will have a little bit more confidence that that will be sustained. So at the moment, bond markets have been dismayed by the fact that central banks don't look as if they'll be able to cut rates as many times as markets and as investors has expected. But we know that central banks, once they move, they tend to keep moving in the same direction. Once they start cutting interest rates, they usually carry on cutting interest rates. So the bond market will certainly seize on that, and that ought to be quite good for equity markets too. So it's been, I suppose, notable that equity markets have done so well in the first quarter of this year, despite the fact that the prospect of early cuts in interest rates has sort of disappeared. And the reason for that is because the outlook for growth and profits has been improving despite that. So at the moment, it's still good economic news. So good reasons to expect equity markets to continue doing well. Reasons to think that bond markets, it won't be long before they start to perform a little bit better. But at the same time, of course, I'd always advise to have realistic expectations about market returns, and we would expect, on average, equity market returns of 5 to 10% a year, and not more than that. And against that background, certainly equity markets have had a good run, but we think they still have a little way to go.
Thanks, Haydn, for such a detailed update. So thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require advice or guidance, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking to you again soon.